And good morning, Don.
Good morning, Pete.
And welcome to Financial and Estate Literacy. This is we're on our last session of our 6-week program. We are, we are unique in that we have only charitable sponsors as our support group. American Heart, Boys and Girls Club, Chapman University, Chalk, the Public Library, the Hemlock Society, In Defense of Animals, Laguna Beach Seniors, Laguna Canyon Foundation, Mary's Path, Newport Beach Library Foundation, Providence Mission Hospital and Mission Viejo, Ronald McDonald House, Susan Coleman, and the Bluebell Foundation. These charities have provided monies for us to put this program together, and we want to publicly thank them. Also,
and incidentally, Pete, what I just did on the website that was up, I just clicked on Chapman and brought it up. So if you are interested in any of these, how you can find them very easily is if you bring up the website, which is on the announcement that you got on a weekly basis for these, then you can click on them. There's a sponsor tab, and you could bring that up. So that's what I just did to bring that up.
Yeah. And what's unique about us is that we don't follow up with a sales call, where no for-profit sponsor is allowed. All of our presenters are not licensed to sell products, and we vet each presenter as well. Everyone, including Don, is a volunteer, as I am myself. Don is our philanthropic advisor and is a board member. I'm the founder of Financial and Estate Literacy, and we've been doing this now almost close to 27 years. And we encourage you to take 2 to 3 charitable charities or missions that you are personally involved in, and support them. Doing good, whether it's for your family or for others in the community, is guaranteed to make you live longer and enjoy life more. And by the way, and that's a true fact. It's been proven through research, and we like it as well. And money is one of the most difficult things to discuss, death and money. And so the thing of it is, both of them are very true, and we need money, and we're all going to die. So
there's an upbeat thing to start out a meeting for. Okay.
So let's get started.
Kevin, you want to bring up your camera?
Hi, Kevin. Good morning.
Hi, Pete. So I'm going to go through, and I will keep an eye on the Q&A. And if I can answer a question, I'll answer it. Otherwise, I will stop us and ask you questions along the way and disappear. Bye.
All right. All right. Okay, Kevin, let's go through your Ask First form real quickly.
All right.
Let's see. I can't read it, so if you
I'm going to zoom in
a little bit.
Yeah.
There you go. You have a master's or other advanced degree. What is that, Kevin?
It's actually a master's of arts. I went through college as a percussion performance major.
Really?
Yes.
Oh, that's cool.
Yeah.
And how did you turn from that into the economics and the financial side?
Yeah, it's kind of a long story, but I'll try to make it short. I moved around. I lived in Houston. I lived in New York City. In New York City, I pivoted into a different career. I worked for a financial printing company that also filed all the compliance documents that public companies have to file, like, an S1 to go public, their 10Q for the quarterly reports, and 10Ks for the annual reports. So I did all that, got really intrigued and interested in financial planning and investments. I had always had a passion for it. I remember when I was a child, my first kind of introduction was my mother teaching me how to invest in a CD at the bank, and I got interest on that money. I was fascinated that I could grow more money from investing in a CD.
Well, so great.
And that piqued my interest. And then I went through the CFP program in Irvine once I moved out here. And
And then you worked for a financial planning firm for a number of years.
That's correct.
And you've been on your own since 2018.
That's right. Yep, exactly. You know me well.
And, let's scroll down. You're a registered investment advisor. How do you charge your clients?
Yeah, I have three main fee structures to be flexible. The one that probably many of these sessions have talked about is the AUM model, the assets under management. I charge 1% up to $1 million, and then it goes down to 0.8% from $1 million to 3, and then down to 0.6 from then on up. And so that's kind of the traditional assets under management. So whatever I'm managing, it's paid quarterly. So it's basically like up to $1 million, 0.25% of whatever the balance is at the end of the quarter. And so that's a traditional model, but that's not just for investment advice, it's for comprehensive financial planning.
Does that include a financial plan?
Oh yeah. Yeah.
Okay.
Yeah. Everything that I'm going to talk about today, which, as you know, is the capstone class. We're going to touch on all the 6 main areas of financial planning, which I'll show the audience in a moment, but it's comprehensive financial planning. The second fee structure is a monthly subscription fee that works best for folks that are still accumulating, still saving, but need some financial planning help and ongoing advice. And then the third one is a project-based structure. Some folks offer hourly. I don't like to track time, and I like to make a clean, accurate quote of what the project's going to be, as opposed to just stacking up hours. So I prefer offering a project-based service for someone that needs just a narrow scope of work, and we define that scope of work, and they'll pay half of that up front and half of it at the end of the project. Wow.
And on your subscription, what do you charge on that?
It depends on the complexity of the client, but it's usually in the range of $400 to $500 a month.
Okay. Yeah. And then do you offer a free review of a person's portfolio?
When I'm first talking with them? Yeah, free consultation, absolutely. Especially, extend that to the audience here. I'm happy to meet with you guys for a free consultation, 1 hour. And even if you don't work with me, I'll give you some advice or some ideas to think about. And if I'm not a good fit, I'm happy to refer you to someone else that I think might be a good fit.
Is really true for most of the fee-only advisors.
Yeah,
that you really want to have a rapport with your clients. A couple of questions, since now we're at the last. Are you a passive or an active manager?
I fall more on the passive side of investment management and investment philosophy. Yeah.
Okay. And approximately how many clients do you have?
35 right now.
And approximately how much do you have under management?
About 16 million right now.
Okay, super.
Yeah. Room to grow.
Yeah, absolutely. Yep. And this is the way to do it. Let's get into the program, Kevin.
Okay, sounds good. Let's move this down here. There we go. That's just a bio on me. I think we talked about enough about me. Let's move on to why everyone's here. So as I mentioned, this is putting it all together. I'd love to know if everyone else or who in the audience has already participated in all the other sessions. I don't know if they can put that in the.
No, it's kind of impossible to do that, but pretty much we've been pretty consistent. So pretty much everyone that's attending has done the previous sessions.
Okay. All right, moving on then. So we're going to cover all the aspects of financial planning. I'm going to teach you everything I know in an hour and a half, which is impossible, but we'll do our best to get you the highlights and hopefully give you some takeaways. We'll touch on the financial planning process. It follows 6 main steps. And then, with a financial planner, we talked, there's a CFP designation, it's the gold standard, the certified financial planner designation. Fee only is the way to go, in my opinion, because it's less bias. We're not selling products and getting a commission, that kind of thing. The fiduciary duty, it just puts your interests first, puts the client's best interest first ahead of ours, and also requires us to be very transparent on how we charge, the services we provide, and how we're going to help you on an ongoing basis. And like Pete said, having a good connection with your advisor is so important. You want to resonate with them and feel like you're going to be able to communicate comfortably with them and make sure that it's a good fit for you. So as Pete mentioned, is also, I think what's important is working with a fee-only advisor, or at least speaking with one. You're going to find that most of them have a heart to find the right place for you. They're not going to really give you a hard sell on working with them per se, but they're going to want to make sure that you find the right advisor for you and your needs. And some advisors have specialties on who they work with or the type of planning that they do. In my case, I started out when I launched my firm focusing on pre-retirement folks, people preparing for retirement or going through retirement. What's interesting now is, as I've developed, 35 clients, half of them are engineers. So I somehow have attracted a lot of engineers. I don't know if it's my personality or how that's come about, because I haven't marketed towards it. But anyway,
so Kevin, you're quite anal then.
Yeah, I'm an introvert, detail oriented. Yeah. Like to analyze things to death,
Yeah, there you go.
Yeah.
When I worked at Long Beach State University, I dreaded going to the engineering department because I could never bring enough books with me to make sure that I had authority as to what I was talking about.
Yeah.
So that says a lot of good things about you.
Thank you.
Let's go to your next slide.
Yeah. So these are the six main areas of financial planning, just to kind of give you a quick overview. Cash flow management is your cash flow statement of what you're spending and what your income is, your income minus your spending and what's left.
And by the way, the cash flow management, that's exactly will tie right into your asset allocation.
Yeah. Yeah. That, and because we want to know what your expenses are. How much are you spending every month? And will that translate over to when you're retired, or if you are currently retired, is that sustainable? So we do a lot of analysis to see if your spending is, sustainable through the rest of your life.
Number one fear for most individuals is, will my cash flow meet my spending needs up until my death?
Am I going to have enough money through the rest of my life? Yeah, that's the question.
Risk management. I find this area to be almost like an art. It's not, it's a science, I understand, but do people really know how much risk they can take or understand the products that they purchase as to how much risk they are taking?
Yeah, it sounds like you're referring to more of the risk on the investment side.
Well, also, yes, but also on the insurance and all that kind of stuff.
Yeah, it can be very confusing. There's on the insurance side, there's a lot of different types and products, and a lot of different people trying to sell their insurance approach. My view is, you only need enough insurance to cover like income replacement in terms of life insurance. For most folks, there are some, kind of remote instances where whole life could be a strategy. I've seen it used for real estate for some folks that are really deep into real estate. But my personal opinion is there's probably other strategies that can be done that are, that are more flexible and give you more options than kind of locking your money in the big premiums and whole life insurance.
And so umbrella policies,
Yeah, for liability, that's your extended liability. If we're talking about homeowners and auto, and there's a whole slide for this later, so maybe we'll come back to that.
I'm sorry. Let's go right through it.
Yeah, so just overview, these are the six main areas, and we have slides for each one of these, and I hope we can get to the end. Sometimes we run out of time, so I'm going to do my best to pace ourselves. But yeah, so let's go into cash flow management. So I mentioned the cash flow statement, that's the income and the expenses. Then usually that's tracked on a monthly basis. There's also a net worth statement, or some people call it a balance statement, or balance sheet. And that's how much you own, like your, the fair market value of your house, any other assets, the investment accounts, all that, minus what you owe. So minus the mortgage, if you have that, the balance of the mortgage, minus the car balance of what you owe on the car payment, if you have one. Hopefully you don't have one. But anything that you owe, any debts, would be what you subtract from that, the assets that you have at the top of the ledger. And so you have what you own minus what you owe, and then the bottom line is your net worth. And I have a couple great spreadsheets on those two. If anyone's interested in them, I'm happy to email it to you. Because one thing I've seen with a lot of net worth statements is they'll do just a snapshot of 1 year, and then they'll update that every year. But I like to do it where you can see year over year, so you can really see the progress from 1 year to another. So I think that's helpful. Emergency fund is very important. 3 to 6 months of expenses is what we've talked about before. That's commonly known. And that's kind of depends on, is there dual income? If there's, two spouses are bringing in income, maybe you can lean towards more 3 months of expenses, because hopefully not both of you would be losing your jobs at the same time. That's really what it's used for, those unexpected expenses or unexpected loss of income. Okay.
I'm a professional fiduciary, Kevin, and I'll tell you, this cash flow management is practically the most important part of meeting with a professional financial advisor.
Yeah.
I had professors who had PhDs that didn't know how to put a cash flow management statement together.
Yeah.
And the only reason why I'm saying that is that most brokers don't do this.
Right. That's absolutely true. And a lot of people, they maybe have tried working a cash flow statement. It's also called a budget in some, in my view, there's a little bit difference in terminology, but it's also kind of known as a budget for the most part. And when you say that word budget, everyone kind of cringes a little bit. It's kind of like going to the dentist and getting your tooth pulled or something. But there are different strategies, different ways of managing a budget. There's kind of a reverse budget where you determine how much you really need to save. And if you're saving everything and you're on target for your goals, you can essentially spend whatever's left because you're covering your goals first.
Yeah.
So there's different ways that an advisor can really structure that cash flow statement or the budget with you that's not quite as painful. But at the very least, do it on an annual basis. At least do it once and see, maybe track the last 3 months of spending.
Even if you don't go to a professional, this is really important to get down on a sheet of paper.
Yeah, you need to know where you're spending, where your money's going.
Yeah, and you're so right. If you can have multiple years, because you can see then exactly that your net worth is either growing or it may be decreasing, and by how much.
Yeah, absolutely.
How you feel and what is reality is a lot of times completely different.
Right. Yeah, you could be earning a whole lot of money, but if you're spending it all, you're really kind of spinning your wheels, or eventually you could feel like you're in quicksand because you're making all this money, it's going out the back door, and you're just not gaining any ground. So you would really want to have a stake in the ground with a net worth statement to see, are you really making progress? And then the cash flow statement, like I said, if you don't do it all the time, which I highly recommend, at least do it once a year, just kind of dive into it, because it builds a lot of awareness of your spending. It's like, oh, I didn't know I was still paying for that, subscription or that app fee or whatever it is. And you can kind of clip off some of that stuff that you're not using anymore.
Yeah. Let's go to the next slide.
Sure. So saving, if you're still in the saving mode of life, the easiest and one of the best, most powerful things you can do is pay yourself first, which means when I say that, I mean, like if you have a W-2 income, you get a paycheck, ask your employer to also auto transfer some money to your savings account, to which then you can take that and transfer it to an investment account and invest it. But you want to have a separate account that goes towards savings. And when it's directly from your paycheck, or once it lands in your checking account, you can also divert it at that point too, either way. But if you can set that on auto pay, auto transfer that certain amount of savings every month, it's kind of like setting it, forgetting it, and out of sight, out of mind kind of thing, where you get it over in that savings bucket, and then anything left in the checking you can use for your expenses. But that alone is a powerful way to start saving, and you can build that up over time and increase the percentage. A very rough rule of thumb is to save, depending on your age and your goals, anywhere from 10 to 20% of your income. Some people have gone higher too, But if you're on the younger side, maybe 30, 35 or younger, you can maybe start at 10% or 15%, unless you want to be more aggressive. As you get older, you need to be probably, and if you're behind, you need to maybe catch up and go to 20, 25% of your savings or of your income.
You
So
know
that's
what I
just
find
something
a
to
lot
consider.
is because I'm dealing mostly with people who are 80 and 90, is that
Yeah,
they're not spending enough, you know,
not
that
spending enough.
not spending enough.
Yeah, yeah. I have some clients like that.
They've saved 50, 60 years and now,
Yeah,
you know, and they don't know the insecurity of not having a paycheck come in.
yeah, yeah. And that's understandable. But that's also actually what an advisor can help them with, to
Yeah,
give them a little more peace of mind and comfort. We can do financial projections and help them to see, like, even if you spend this amount, every month, we have this much left. And, the projections show that that's a very safe spending rate,
yeah.
So,
And what happens too here in the United States is that older people have the money.
yeah,
So because they've saved their entire life. And
yeah,
so they become uh, prime targets for scams,
yeah, it's dangerous.
predatory practices. So, one of the things that I think a fee-only advisor is really good for is to help prevent the big mistake.
Absolutely.
Getting involved in a lottery or getting involved in some sort
Yeah.
of a scam or,
Yeah. You get those things in the mail,
yeah,
like, oh, you better, reply to this bill, and it's not a real bill.
somebody to call, just say, hey,
Yeah.
what's up?
Is this legit? Am I supposed to react to this or not?
Yeah,
And
let's go.
oftentimes we're like, no, that's a scam. There's some really fine print
Yeah,
that if you get a huge magnifying glass, you can read, and it says advertisement only or something like
yeah, exactly.
that. Yeah.
Let's go to the next slide.
And we serve as a great thinking partner too, just to kind of think through different planning scenarios. So this is a risk management slide on insurance. There is investment risk that we'll talk about too, but this is your health insurance. And if you're older, it'd be Medicare. There's homeowners insurance or renter's insurance if you're renting, auto insurance, and then personal liability is the umbrella policy.
So
And
do
the umbrella,
you do all these things with your client?
oh yeah, I cover all this. I mean, I don't sell insurance.
No, I mean, but you actually look at the policies.
Oh, absolutely. Yeah. I look at it, and then since I don't sell insurance, I have other professionals that I reach out to that can quote, like a competitive quote, to give you a sense of if you're overpaying on the premiums of any of these, or if you have like this old life insurance policy, you're like, is this worth keeping or not? We can do an analysis together and get comparison quotes, and it gives it more perspective on what's good and what's not. And it also helps you to understand if you're sufficiently insured in all these areas. And
Yeah,
so
we're just hitting on November. So what we're getting in the mail right now is all of our Medicare choices,
right,
for what kind of a plan to get in Medicare. Are you getting those kinds of calls today, or is that pretty much?
Well, oftentimes when they're just turning 65, we usually focus on that 3 months before they're 65, and we work through what's appropriate for them. And of course, you can change that every year if they want, but oftentimes they're still happy with what we chose. But I also have an independent consultant on that as well that's more of an expert.
Yeah.
To help educate my clients on that and collaborate with the consultant. And they don't even charge anything for that.
You know what, the guy that I use, what he tells me anyway is that he said he recommended I should review my health plan every year. And he says make sure that I understand the prescription drugs that I am particularly on. He says, because the coverage changes every year on those prescription drugs, and that all health plans have the same commissions. So no matter what agent you use, the commission structure is exactly the same. Anyway,
Yeah.
so
Yeah. If they're independent.
information that might help someone.
Yeah, that's excellent.
Let's go to the next slide.
Okay. Yeah. So these are just breaking down each one. So I kind of mentioned this. If you're not quite Medicare age at 65, but you're retiring before that, you would probably go through Covered California on the open exchange, and you can get insurance that way. Waiting till 65 to retire can help a lot financially, because the premiums can be rather expensive when you get it on, if you get it on your own. If you're still working, obviously most folks can have health insurance at their work. That's obviously the common route to go. You can track your medical expenses. It's kind of a high hurdle to deduct that from your taxes. You have to get above the 10% floor, or is it 7.5% now? I think it might be 7.5, sorry. But yeah, you have to get above like 7.5% of your AGI before it's deductible. And so if you do have a lot of medical expenses, then absolutely track that, and you probably could deduct some of that just to keep that in mind. You know, that's kind of what I'll say about that. It's also open enrollment for a lot of folks that are working right now, and a good advisor will help them work through that. If you have an HSA option and you're healthy, there's a lot of great strategies around that. HSA stands for Health Savings Account, where you can deduct money going in. So it's like a pre-tax deduction, and then it grows tax-free and comes out tax-free for medical expenses. And
none of this stuff is easy.
No, there's a lot of steps to it, and I know I'm flying through it.
Yeah, you know, unless you're steeped in it, and then, you know, this is part of the 1% fee.
Yeah. Yeah, and just that one planning thing, or you know, with the HSA strategies, there's a long-term strategy with the HSA where you, instead of reimbursing those medical expenses every year with the HSA, you actually keep it as long as you can, and you can actually invest it while it's in the HSA account, almost like a 401k. There's a menu of investment options, and you can invest it for the long term and then use it for long-term care expenses or premiums down the road. So
okay, let's get to the next slide.
All right, yeah, moving on here.
Let's move on from there. We already talked about that. Let's move on. And briefly, long-term care insurance is almost non-existent today.
Well, the traditional type, especially, where you're paying a premium, and there's, I think, many pitfalls to the traditional long-term care policies where, you know, you pay a premium until you actually qualify to use the policy, and then it starts to pay out, usually after 90 days of having, you know, kind of qualifying. And in most cases, it's when you can't do 2 out of the 6 activities of daily living that you see listed here. So a doctor will kind of check you out and say, okay, they can't do these 2, you qualify, but then you got to wait 90 days and then it starts paying out. The danger with that is you've been paying premiums, and maybe you've been really healthy until you get a lot older, and they can raise the premiums on you, and you start getting squeezed, because just as you really need it, the premiums are really going up, and then you're like, I can't really afford to pay the premium, but I think I'm going to need the insurance soon. So that's
it's a very difficult situation. Also, the Council on Aging locally will review all your medical and your long-term care policies if you don't have a fee-only advisor. Let's go to the next slide.
Well, just one other quick thing, because I said, you know, there's pitfalls with the traditional long-term care. The ones I tend to recommend is what's like called a hybrid type of long-term care policy, where it's a life insurance and long-term care rider to it, where if you die in your sleep, you know, you wouldn't need the long-term care because you died in your sleep, but the death benefit of that hybrid policy would go to your heirs. And you can pay that up front. You can pay it as a lump sum policy, or pay it over 10 years. And then once it's paid in full, there's no danger of rates, you know, the premiums being raised or anything like that. So there's less chance of, you know, premium increases. So I just want to mention that. You guys can look into that further if you're interested.
Yeah, and that's all risk management. So now we get into the investment management.
All right, yeah, we're on number 3. So investment management, you had some sessions that are really deep dives into this. So I'm just going to touch the highlights. Risk and return is so important, and everyone focuses on the return, like what kind of rate of return am I going to get every year? But the risk side is what people don't understand and can get them in big trouble, you know? And so some investments are higher risk and some investments are lower risk. Roughly, stocks are going to have higher risk. And there's obviously different kinds of stocks. There's, you know, the large cap, big companies, the small cap, smaller companies, and there's even, you know, penny stocks with these micro investments, and those are really risky. So the bigger companies are usually lower risk, the smaller companies a little higher risk. And you know, if you invest on individual stocks, then there's, you know, concentrated risk on that specific company, as opposed to, you know, maybe investing in mutual funds or ETFs. Those are like a basket of companies, or usually hundreds of companies within one mutual fund or one ETF. ETF is exchange traded funds. And so that's a way of diversifying as well. Bonds are more conservative, lower risk. We talk about volatility, which is kind of how much the investment tends to go up and down in the market over time. And so bonds are going to give you a smoother ride. Stocks are going to be more volatile and a little more risky. And you know, there's levels of risk within each one of those. So
who do you use as your custodian?
My custodian is Charles Schwab.
Charles Schwab. Yeah. And do you, what is your main primary fund that you use? Dimensional or Vanguard or some other?
Right. Yeah, exactly. Yeah. Those are the two main ones I tend to prefer, just depending on which ones seem to work best for the client and how they're performing. But those are literally the two I use a lot, primarily.
And the reason why you use them is because
they're low cost, good quality investments. Yeah, absolutely. Yeah. And so, most people have probably heard of Vanguard, but they may not have heard of DFA, Dimensional Fund Advisors.
Dimensional Advisor Funds.
Yeah.
They're now available through an ETF to
the
public. So,
yeah, but you have to go through a kind of a DFA approved advisor, because it follows a specific philosophy.
So in the investment area, one of the most important things is your asset allocation.
Yeah.
When you have a new client, is that one of the first things you look at to see how they're allocated between some bonds?
Yeah, absolutely. You know, how are they currently invested? In some cases, they're already in some mutual funds and bond funds. In other cases, they have, you know, many individual stocks, or maybe even 100 of them, in which case we take a look at the tax impact of shifting that into more of a diversified portfolio. And we may have to do it over a multi-year strategy to kind of rein it in and get it in a more diversified type of portfolio.
So everyone listening should know their asset allocation.
Yeah. And what we're talking about is like, what percentage is in US, what percentage is of your portfolio is in international, what percentage is in real estate. And we look at those percentages and try to determine, is that a good balance for you and your goals? And you know, a good advisor is going to learn not just about your risk tolerance and how old you are, but also what's important to you and what your goals are in life. And, you know, is there anyone that's going to rely on you financially now or in the future? We may have to have some part of your portfolio focused on a longer term than what you actually need in your life. So there's a lot of you know, things to consider when we're looking at your portfolio. And
the big change today is, you know, that from the last 5 to 10 years has been the whole bond area. It's a ball game in the bond portfolio. Because you're actually starting to earn interest again.
Right. Yeah. We kind of took the hit in 2022 to make that shift. For many years, you weren't getting much of any fixed income or bond return because the Federal Reserve rates were so, you know, low. And so over 2022 and part of 2023 with the Fed raising rates, that's kind of shifted things over time. And during that shift, you know, it was a big change in the rates. It took some time, but now we're starting to see the fruits of that labor, and it's actually kind of righting the ship and giving us more return on that fixed income side.
On the fixed income side today, Kevin, are you doing what's your duration for what's the max duration you're willing to go out so far today?
Yeah, right now I'm either in short-term bonds for some clients, which is like 1 to 3 years, or you know, money markets and treasuries are paying really well right now as well. So it just depends on the client, and then oftentimes I'm going to have a mix of those. So for really liquid amounts of the portfolio, if they're going to need some cash for, you know, payments every month for retirement, I'll keep that liquid amount in a money market. And you know, there's one right now that at Schwab that has an SEC yield projection of like 5.2% just for a money market. So that's pretty amazing, and it's pretty darn safe. It's not as safe as the FDIC insured CD, but it's pretty, you know, it's pretty safe. And so that's on our conservative side. Yeah.
If I met you on an elevator, Kevin,
yeah,
time, and give me your elevator speech as to your investment philosophy strategy.
Okay. Yeah. So great to meet you. My investment philosophy is low cost, good quality investments, primarily with mutual funds or ETFs, which is, you know, a well diversified amount of companies in large cap, mid cap, and small cap for US. So I have a percentage of investments in that, percentage in international, emerging markets, real estate, and then bonds, like short-term bonds and cash and money markets. And we determine what the right balance is for you. But I don't try to time the market. I focus on the long term and really kind of just keep you on target for those target percentages of each of those asset classes. And we'll rebalance that portfolio to kind of bring it back on target on average, you know, once or twice a year, depending on the movement of the market.
And so what do you mean by benchmarks and indexing?
Yeah, so benchmarks, most people have heard of the S&P 500 or the NASDAQ. You know, those are kind of benchmarks that you can kind of compare your portfolio a little bit to. Obviously, it's not for most clients. Hopefully, it's not exactly like the S&P 500, but part of your portfolio would be similar to the S&P 500. So it kind of gives you, it really, I think, you know, just gives you a sense of the overall market and different benchmarks and indexes to see which different parts of the markets, how they're performing. You know, so there's bond indexes that, you know, it tracks a certain amount of bonds to give you a sense of what the direction is.
And are you using more treasuries today, or are you staying in the corporate bond area?
I'm there since the money market. I was looking at treasuries, but since the money market that I'm using is doing as well or better, I'm just sticking with a money market for a lot of that short-term stuff, right? You know, short-term.
It's a great way to save for your everyday expenses. You know, I mean, having
that, and you know, unlike a CD where you lock it in for a time period, a money market fund, you can liquidate that and get it traded at some point down the road if you want to shift some of that into, you know, more of the growth part of the portfolio. So it just gives you more flexibility in some cases.
Getting away from using banks. I'm to use Schwab more and more. By the way, Schwab is not paying me to say this.
No.
But, Schwab is just the low cost leader, and they have a money market fund that pays 5.2%, and you can write checks on your brokerage account.
Yeah, you could. Some advisors don't allow that, but some do.
Let's go to the next slide.
Well, one other quick thing on this, which I actually don't have on here, but the investment location is really important. And you're probably saying, what does location mean? And what I mean by that is how you're like, if you look at your overall portfolio, you probably have some part of it that's more aggressive, like the large cap part of your portfolio, large cap investments that's focused on growth versus the bonds. And so if you had a choice of putting a growth type part of your investment in a Roth IRA or Roth 401k versus an IRA, which one would you put it in? And in my view, the answer is the Roth IRA, because it's going to grow, that investment should grow more than a bond fund. And when it comes out, it'll come out tax-free. And so why not put your racehorse in the Roth IRA, something that's going to grow more, presumably, than a bond fund. And then the other thing is looking at the tax impact. So bonds kick off income. If it's inside of an IRA, and you're not going to pay taxes on that until it comes out for retirement. And so there's a real tax effect that you got to think about and how you're structuring your portfolio or designing it. So that's a really important point too, that most most consumers don't think about.
Yeah, I love this slide.
Yeah, this one's got many names. The Skittles chart, or the quilt chart, kind of looks like a colored quilt. You can see the different asset classes here listed, and it just demonstrates over time in different years how each one has done great on one year. Like if you look at this US real estate in 2006, it was the winner. It was the biggest return of the year, but the following year is the worst, right? So you can't really rely on one asset class to be the best performer year after year after year. And so it really just demonstrates the power of diversification, so that in any given year, you'll get some good return. And the other ones that are more conservative is going to taper down some of the downside of your portfolio. So I think it just illustrates the power of diversification really well.
If somebody were to ask me the two most important parts about investing, I would say asset allocation, and I would say diversification.
Yeah, absolutely. And this next chart just gives you a sense of, we talk in the profession, we talk a lot about like a 60-40. That's kind of the most common retiree allocation for a portfolio. And so what does that mean? Well, the 60% represents the equity or the stock portion of your portfolio that's a little more aggressive, growth focused. And the 40% would represent more the conservative side of your portfolio. So that would be your bonds and cash and treasuries and money markets and CDs, all that kind of stuff. And so it's not to say that everyone should have a 60-40 portfolio by any means, but it is, I would say, the most common kind of broad allocation that we tend to recommend. But there's certainly some that are like a 20-80. You see a 20-80 down here where they're more risk adverse. They don't need to take on more risk. So we have only 20% to, on the growth side, and 80% on more of the bonds and treasuries. So it just depends on the client and what their goals are and risk tolerance.
But here, the terminology has become so important again. It says, people ought to know their tax bracket. People ought to know their asset allocation. It's those things that you not the first question should be, hey, what kind of return can you get for me?
Right. Yeah.
No, it's
that's overlooking a lot of things.
Yeah.
Get people in trouble.
Yeah.
And when things are all rosy in the market, people are like, oh yeah, I got an 80-20 portfolio and we're rocking. And then, 2008 comes and the market tanks and their portfolio goes down 35%, as it should, because they're more aggressive. And they're like freaking out because they can't hang on at the downside of the market, and they want to get out at the worst time and, sell low, which is the worst thing to do, which is very damaging. And what that means is they were happy when things were going well, but they didn't tolerate the downside. And that's where we have that conversation with the client to determine, how much can you tolerate without jumping out of the market at the worst time.
That's another good reason to have a fee-only advisor. It's to prevent you from making that mistake.
Yeah. I like to use a roller coaster analogy for risk, where, you go to the park and you have that nice smooth train that goes around the park, and that's nice smooth ride. That's like your bond allocation or a more conservative portfolio. But then you have that white knuckle ride that you're doing loops on, and that's the more aggressive 80-20 type portfolio. And as you can imagine, I don't like really rough roller coasters. So I'm a little more risk adverse. So I don't want to jump out of my seat when I'm on that white knuckle ride. So I'm not even going to go on that ride, right? I'm going to go on something a little more stable and comfortable. So you have to find what fits well for you.
Let's go to the next slide.
Yeah. So this is just talking more about diversifying your investments. There's all kinds. There's growth versus value, a type
Well,
of
the growth versus value, meaning what is better. I think people should have both in their portfolio.
Yeah, there's something to be said to having diversification there as well.
Yeah,
each one has their day in the sun.
The S&P 500 is a diversified large cap portfolio.
Yeah, and there's going to be growth and value companies in the S&P 500. Yeah, and this just, I mentioned large cap, mid cap, small cap. This just kind of just defines what that is, where companies over 10 billion of market cap is going to be a large cap, that kind of thing.
Yeah, but what's important to know too is that your small caps are going to be more volatile and will have a better rate of return long term, but that that roller coaster ride is going to be heavier.
Exactly.
So,
yeah.
The mid cap is going to be a little less, and the large cap much less. Hopefully, that's more stable.
Exactly. And even with those, there's a tax impact to consider. Large caps tend to pay out dividends. And if you have that in a taxable account and in a mutual fund, that's going to pay out dividends that you're going to have to deal with tax-wise. It might be a qualified dividend or an ordinary dividend, depending on how it was traded in the fund.
Gains income.
What's that?
You want capital gains income.
Yeah. It's a good diversifier just on the income side. We're talking about bonds providing income, but dividends as well from large caps can add that cash that you need every month for retirement.
Kevin, do me a favor, back up a slide.
Yes, sir.
Looking at this, a question that come in on this slide: people are living longer and with advances in medical capabilities. Mm-hmm. The issue is, are we going to live to be over 100 years old? Mm-hmm. Does this chart relate to what I should invest in if I'm going to live a long time?
Well, that's where you work with an advisor. We talk about health history with like a family health history, and then also talk about the individual's health. And if they do think that they're going to have a long-lived life, or they just want to be on the safer side and make sure that, like, I want to make sure I have enough money to live to 110. If that's what they really are set on, we can set up the portfolio in a manner that's going to help get them to that age. But it really depends on the client, and you got to work with the client on that. But in terms of the chart and the allocation,
it's not just age related.
No.
Well, and obviously risk and everything else. And to be clear, this chart is not saying you should do this if you're going to live to 110. I mean, it doesn't say if you're going to live between 85 and 90, you should do this. It's not it. It's with these mixes, this is the historic return.
Right.
But what was your risk tolerance? What is your asset base? What are all the other characteristics? Yeah. So it isn't a simple answer from that standpoint.
No, it's not. Yeah.
Okay. Just want to make sure.
There isn't
many factors.
Really,
what's the magic bullet here?
So simple.
We'd love to have it. Love to have it.
And it also depends on what your portfolio size is. If you have $10 million,
what's the
you don't have to take on more risk, and you probably will have enough till you're 110, right?
Yeah.
But that depends again. That's even depends again on your spending.
Yeah, your expenses and your overhead. Maybe
if you're spending over $1 million a year.
Yeah, it really does depend.
Yeah.
Okay, moving on here. Are we ready to go to tax planning?
You bet.
All right, this is a good one because everyone's got to deal with taxes every year. I don't know why they call it a tax return, because they don't return much to you, right?
I love that line.
But there are some key areas of the tax return: the adjusted gross income. So you have your income at the top, and then some above the line deductions, which is above the AGI, adjusted gross income. And then you get that adjusted gross income number, which is an important number to be aware of, especially if you want to see if you qualify for other deductions, or you want to make an IRA contribution or a Roth contribution. A lot of that is going to stem off of that AGI number.
I see, about 90% of my clients that are 65 and older are taking the standard deduction.
Yeah, now that it's gone up from the Tax Cuts and Jobs Act, they raised it up much higher.
All your itemized stuff is just out the door.
Yeah, that,
unless you bundle or you do some real.
Yeah. So not only did they raise the standard deduction, but they also clipped our wings on the SALT, the state and local tax. They capped it at $10,000, which for our fellow Californians, for many of us that own a home here with, maybe some mortgage interest and things like that. Well, actually, it's not the mortgage; it's a property tax. Many are paying much more than $10,000 on their state and local tax and their property tax, and so we're not getting as much of a deduction because it's capped right there at 10,000. So you're right, and then minus the standard deduction or the itemized deduction. Itemized deduction is going to be on your Schedule A. Gives you roughly, gets you down to the taxable income number. And then you get that number minus the credits if you have any, and then they take that number minus whatever you've withheld already, whether it's withholding from your paycheck or making estimated tax payments, and then whatever's left is what you either owe, or if you over withheld, then you would have a tax refund.
Yeah.
Okay, so those are things to be aware of. That's just kind of the overall of how it works.
Couple items in the tax planning area for you've gone through this in previous sessions. And you look, let's go to the strategy sessions slide first, because you may cover it.
Yeah. So before I go there, the marginal tax bracket, there's two kind of types of tax brackets or tax rates that we talk about in the profession. There's the marginal tax bracket, which is the top rate that you're paying in your taxes. The effective rate is kind of a mashup of all the brackets you paid up until the top bracket. It's almost like an average of blending all those taxes you paid, and it's going to be a lower rate than your marginal tax rate. So knowing the marginal tax rate is usually is the most important, because there's a lot of strategies you can do around that. So let's talk about those strategies. There's deferring income. So this deferring income is like you're making an IRA contribution, or if you're still working, making a contribution to a 401k. You're deferring that income, where oftentimes you'll get a tax deduction for that contribution in the current year. And then, when the money comes out of the IRA or 401k down the road when you're retired, that's when you pay ordinary income taxes. And that's an important tax piece right there. When it comes out of the IRA or the 401k, if it's a pre-tax account, you're going to pay ordinary income tax. So whatever your tax bracket's at in that year, you're going to pay that rate. And so say you have $1 million IRA, you don't really have $1 million, because after the taxes are pulled out, you probably have maybe 600,000. So that's something to be aware of, and look at your overall investments and assets and see, how much of my nest egg is pre-tax, how much of it is in a taxable account, like a trust account, joint account, or brokerage account. Those are going to be subject to long-term capital gains. And then how much is in a Roth IRA or a Roth 401k, that's going to grow and come out tax-free. So those are your kind of three tax treatment buckets to be considering. But the defer income is going to be that pre-tax type of account. Another strategy is accelerating deductions. So that's kind of the tax bunching or tax clumping that we talk about. You can focus as many of your deductions that you're going to do in 1 year. So you can prepay your property tax and kind of bunch that in 1 year, for example, and get more deductions. If you're charitably inclined, you can make more contributions in one single year. There's something
through a donor advised fund.
I was just going to say that. There's something called a donor advised fund, where you make that contribution to the donor advised fund, and then you essentially lose control of it from a tax perspective. You get the tax deduction that given year, and you really forfeit any kind of use of it for your own purposes. But then you can dole it out in any given year for any type of charity. So you don't have to donate it to a specific charity in the given year, but you can focus all the contribution in a given year for the deduction. And so that's where, like, if you anticipate maybe you're selling your house and you've got a long-term capital gain in a given year, you could say, well, to offset that gain of the house, I'm going to do a donor advised fund. I'm going to throw 200,000 in that, and then that'll be my bucket to send to charities for the next 10, 20 years.
For most folks, though,
Yeah.
I don't believe most folks are bundling or clumping.
Right.
But for most folks, if they're 70 plus, they need to start looking at QCDs, qualified deductions, qualified donations from their IRA account.
Yeah. And like you said, it depends on the complexity of your portfolio and your situation. Because the donor advised fund is a little more involved. There's some kind of maintenance to do and tracking, but the step down from that in terms of kind of more straightforward would be that QCD, the qualified charitable distribution or donation rather. And we like to do that in tandem with an IRA. So you can, if you do it right, you can use part of your RMD, the required minimum distribution from your IRA to a charity, and not pay taxes, not pay any penalty or anything like that. And it just goes directly to the charity and serves as part or all of your RMD for that year. So that can be really valuable strategy for folks that are charitably inclined.
Yeah, and I think we know about Roth IRAs, but what people don't do on an annual basis is kind of look at, should I transfer part of my regular IRA into a Roth IRA?
Yeah, that's talking about Roth conversions. And that's a really big planning item, especially right now. And even the last year was a big year too, when the markets were really down. And there's a lot of different ways of like pros and cons to it. But what we're really talking about essentially is maybe you're capping out at a 24% tax bracket in your tax return, but you still have $50,000 left in that 24% tax bracket. The next tax bracket above that is 32%. And so what we can do is fill that 24% tax bracket in a given year by doing a Roth conversion. There's no income limit. There's no age limit to do Roth conversions. And so we fill that 24% tax bracket. You will have to pay taxes on that conversion, but once it's in the Roth, it grows tax-free and comes out tax-free. So incrementally, we're moving that over.
In all these kinds of plans, the idea is to run the numbers.
Yeah, that makes sense.
Numbers to see whether or not it works for you. Does it meet your goals and objectives? You have to know and think about how long you're going to live, who's going to be a beneficiary of it. It's not a slam dunk as to, doing one way or the other.
And when I'm doing tax planning, I'm not trying to get you the lowest, tax payment in 1 year. I'm trying to get you the lowest tax payment for your lifetime tax. In your lifetime, there's a lot of strategies we can use year after year where we're incrementally, shifting things in a more tax effective manner to where, long term, you're going to pay a lot less in taxes.
Don, you have a question.
Actually, I want to raise two issues. One is on a Roth conversion. So I'm 74. Mm-hmm. Don't I have to keep it in the Roth for 5 years before I take it out tax-free?
What's that, Pete?
Not the principal. You can take out the principal, but you can't take out the earnings for 5 years.
Okay. So I knew there was some restriction to it. I thought it was 5 years for something with it. I couldn't remember what all it was.
Yeah, that's
the other
true.
thing. We haven't really talked about capital gains tax.
Mm-hmm.
So you can have marginal, you can have effective taxes, but capital gains we haven't talked about. And the other is, how is Social Security taxed?
Yeah, I have a slide for the Social Security coming up. Hopefully, we should get to that. But capital gains, that's a good one, and it's so important. It's really confusing to a lot of folks. So capital gains, what we're really talking about when we're talking about capital gains is when you have investments in what we call a taxable account. That can be, again, it could be your individual account, like a brokerage account. It could be a joint account. It could be a trust account. But typically it's like a brokerage investable account. In other words, it's not an IRA, it's not a Roth, it's not a 401k, it's not a qualified retirement account.
Not an annuity.
Right. It's just
it's also your potentially your house.
Yeah, and a house has gain in it. And so when you buy an investment, whether it's a house or a stock or a mutual fund that's in a taxable type of account, whatever you paid for that, that's your cost basis. Okay, that's what you paid for it. If it grows and goes above that cost basis, that's your gain. Okay, and so whatever that amount is above and beyond the cost basis, when and if you sell it, is going to have a capital gains tax treatment. If you only held it less than a year, that's called short-term capital gains. And short-term capital gains is subject to your ordinary tax brackets. So if you're in the 24% tax bracket, that gain is going to be taxed at that 24%. If that's where it's capping out. If you've held the investment for longer than a year, though, then it's subject to what we call long-term capital gains, which is where you kind of want to get to ideally for your investments, because that's a lower, usually, or it should be a lower rate for you capital gains.
15%.
For most people, 15%.
For most people.
Yeah.
Not only that, but you can have up to $44,000 worth of income, capital gain income, and pay zero.
Yeah. Good.
No, Pete, capital gains is based on your total. The rate is based on your total income. If you're correct. If you had 80,000 as a couple and it was your only income for the year, you're absolutely spot on correct. If you have any other income, it could push you into a higher bracket. So we need to be a little clear on that one. The other thing I wanted to say, and you have it buried down here a little bit, tax loss harvesting. So if I have capital gain losses on my brokerage account and I sell my house, some of that loss can offset the gain that I had in my house.
Yeah. First, we offset our investments, gains versus loss. Okay. And if there's more loss left at the end of that, you can deduct an additional $3,000 on your ordinary tax, and then the rest is carried over year after year until you can use up all your your loss carry forward.
Okay,
that's right. Yeah. There's three main brackets for capital gains. There's the 0% bracket, 15%, and then 20%.
I think the point is, for everyone listening, is just
run the numbers.
Just on tax strategies alone.
Yeah.
The fee that you pay a financial advisor can return that money, that fee double at minimum, just on tax strategies, not even talking about investments or health insurance or doing some financial planning for you. It's that's how important tax strategies are.
Yeah, and it's every year, and it's not even once a year in my case. I like to do tax planning all year long, and we do different things at different points of the year. But we find mistakes too in the tax returns, or I get new clients and I look at the last year's tax return, they paid an underpayment penalty because they didn't withhold enough. And that's just like burning money. You didn't have to, lose that money if you had, withheld enough. And so a good financial planner is going to prevent you from under withholding.
This is another reason why it's really important to understand how many clients does the financial advisor have? Yeah. And, I think the max that you can possibly handle is approximately about 100 in the clients.
Yeah, typically. It depends how deep of financial planning they do.
You can't do all the things that you need to do for a client if you have more than 100 per employee as you grow. Kevin, I don't know if that's how you feel about that. What is your kind of target level in your practice as far as number of clients are concerned?
Yeah, it's if I hire some additional employees to help support me, I would easily get up to 100.
But even there, you would need support.
Yeah, more support.
Yeah. The average broker has 1,000 to 6,000 clients.
Yeah, they're more focused just on the investments. They're not doing comprehensive financial planning.
Yeah, even if you hire an advisor through Schwab or Fidelity, they have approximately 300 clients per advisor.
Yeah,
you can't match.
Can't do the deep planning.
Yeah. You can't warehouse people into these separate, because we're all different.
Yeah.
Let's go to the next slide.
Yeah. And one other thing I want to say real quick on this is that there's tax planning and there's tax prep. You know, you may say, well, I have a tax accountant to help me with this stuff. They're focused on more of inputting the stuff that's already happened in the rearview mirror, what happened last year, and just inputting that data and getting the tax return done. If you're lucky, after tax season, you schedule a meeting with them, they might go into some tax planning. And even then, some of them tend to shy away from some of these strategies because they're not trained in those areas.
They're accountants.
Yeah.
They have to account for what has happened.
Right. Yeah. So I say they're focused more on the rear view mirror. The planning is focused on the, you know, what's in the front windshield, what's going on in the future.
Let's go to the next slide.
Okay. So retirement planning.
So by the way, most of our audience are already retired. So I don't want to spend too much time on the aspect of trying to retire, but more on what do you do when you're retired?
Yeah, what I like to do is set up their monthly paycheck. And what that means is we look at their overall portfolio, determine what their expenses are, make sure that's a reasonable expense amount that's sustainable, right? And then we figure out from which accounts does it make most sense to make those distributions on a monthly basis to their checking account. And maybe it's $5,000 a month. And so we determine which accounts it's going to come from and auto pay that straight over to their checking account. They get that 5,000 every month, and they can
like a paycheck.
Yeah, their paycheck. It's just like a mock paycheck from a job, but now it's coming from your portfolio. But it's got a lot of thought behind it to confirm that it's going to be sustainable and it's tax effective. You know, we're pulling it out of the right accounts at the right time, so you're not going to pay too much on taxes.
Yeah. Can you spend principal in retirement?
Well, you can, yeah.
Well, you know, when you're 90 years old, you know, I mean, some people believe that there is an 11th commandment out there that says thou shalt not spend principal.
Right.
You got to do it carefully.
Yeah. And we look at that and try to coach them on what is sustainable, what's safe, what's comfortable, and give them some peace of mind so they can sleep well at night, you know, on that.
Sleeping at night is important as we get older.
Yeah, there's a big value to that, right?
Yeah. Accumulation versus distribution, or you're talking about retiring.
Yeah, accumulation is before you retire, you're saving still towards retirement. Once you retire and you're really relying on your portfolio, your nest egg, then that's your distribution phase. And like I said, we look at that every year to make sure you're on track, make sure you're not overspending. And there's some really great strategies around doing that where it doesn't have to be that $5,000 every month. You know, in retirement, I like to say there's 3 phases. There's the go-go years, the slow-go years, and the no-go years. And, you know, when you're younger in retirement, you probably will spend more. You want to travel, get out there, play with the grandkids, whatever it is. So you may spend more in that first phase, but then
next slide.
Yeah. Oh, there it is. Go years, slow go years, no go years. You can see it right there. Yep. I had a feeling it was coming up. So yeah, oftentimes you see differences in expenses in those 3 phases. Again, more activities in the first phase, more on medical costs in the last phase, and then the middle one's a little more kind of even keeled. But we can coach and help you with that as an advisor because everyone's life is different. Everyone's goals are different. So,
you know, that's where we talk about the no-go years. You know, you may have caregiver costs that increase dramatically.
Yeah, and we can project that. We can build that into the plan to see, you know, what if you know, maybe your family has Alzheimer's running in the family and you want to build in, you know, a higher expense for 10 years or something like that. We can build that in and say, hey, even with that.
You know, that's why it's so important to have rapport with your financial advisor, because you want to talk about your health with the advisor. You want to talk about family health issues. You know, even for family members, you want to talk about who can handle money if in the event that you have dementia or Parkinson's or cancer. You know, I mean, your financial advisor should be your partner.
Yeah, your trusted partner.
With the money. It's I don't know of a more important individual within in somebody's family than the personal financial advisor.
And that's where it's really satisfying to help folks that are in that situation where you've known them for years, you know what they want or what they don't want. And especially when they're dealing with their adult children, some of them may be dysfunctional. You can kind of serve as a mediator between the family in some cases and have some difficult conversations with them. Or you can also be the bad guy. You know, the clients can blame the advisor. Well, my advisor says I should do this. And
Yes.
we're happy to take on that bad guy persona for their, you know,
And if you have a large family and you don't have someone that's dysfunctional, then you don't have a normal family.
right. Well,
let's go to the next.
Or that may mean that you're the dysfunctional person.
Yeah.
If you can't think of anyone else.
Yeah. Let's go to the next slide.
All right. So how much do I need? We won't spend much time on this, but it is kind of a nice chart to give you a sense of, you know, if you assume a 3% inflation rate over a 30-year retirement, and say my expenses are $100,000 a year in retirement, and it's pre-tax money. If I have a portfolio of a rate of return on average of 5%, that would mean I would need a $2.3 million nest egg starting in retirement. So that's kind of how to read this chart.
Yeah, you know what I like to see in this chart is that encourage your children and grandchildren to start saving early and allow compounding to work for them.
Absolutely.
Allow money to make money.
Absolutely. It makes a huge difference. And this just gives you a sense of like if you were younger and you need to know how much to save, this kind of gives you a projection over 20 years for, as an example, how much you need to save per year. So that shows you the power of compounding too. Okay.
And the only thing that, you know, you can't control your returns. You really can't.
Right.
The market does that, but you can control your expenses.
Right.
You know, and you can control some of your taxes.
Yeah. Right.
So there's some things you can control, but investment return is beyond your control.
I mean, you can structure a nice portfolio that's diversified, like we talked about, but there's no guarantee of what the rate of return is going to be on any given year. You can make a kind of projection long term of what you should expect that to be, but there's no guarantee, right? And every year is going to be different. So this is just gives you the numbers. If you want to make contributions, the max for a 401k in 2023 is $22,500. If you're under 50, if you're 50 or over, you can do an additional $7,500. And that can lower your taxable income. So if you're in the 32% tax bracket, maybe you're tipping into that, and you still have time to make more contributions to that 401k and a pre-tax contribution. You could, you know, put more in now and bring it down to that 24% tax bracket and save yourself 8% of taxes. So there's things like that we look at. That's why knowing your marginal tax bracket is so important. So you know if you're going to tick up to that next bracket or not.
Even we don't talk about philanthropic strategies much in It's Your Money program, but you know, even if you have a stock such as Berkshire Hathaway that's not paying any dividend and you need more income, maybe a charitable remainder trust might work for you, or a charitable gift annuity. Even if you don't have a philanthropic bone in your body, it's just that those kinds of plans offer you to turn that investment without paying the capital gains tax or ordinary income tax up front. It defers it over the lifetime. And so it may work out for you better than maybe a commercial plan.
And I have many clients that don't have any children, and they don't really have anyone they particularly want to give their money to if they were to pass away. And so the charitable, even if they're not charitably inclined in their life or while living, you know,
it might just work out financially for him. But
it's better than giving it to Uncle Sam, right?
Well, you know, you have to run the numbers is what I'm kind of, you can't just make these opinions as to what's best for you, how you feel. Your mind sometimes is the worst aspect of doing a good financial plan. Let's go to the next slide.
Yeah. So these are some common income resources in retirement. Many folks are going to have Social Security benefit, the employer retirement plans, 401ks, a TSP, whatever it may be, 457, 403b. Those are all qualified retirement plans. Some of you may be lucky enough to have a pension, and we look at that. If you haven't retired yet, there's usually a calculation to do and conversation to have on whether to take the lump sum and invest it on your own and control it on your own, or have a monthly pension benefit that's paid out. And even with that, is it on just your life, or is it on you and your spouse's life, 100% for each, or is it your benefit and 50% on the survivor benefit? So there's calculations and conversations to have there on what makes most sense.
Hey, Kevin, this is why having an engineering kind of a mind is really important.
Yeah, do a lot of spreadsheets.
Yeah, you have to look at so many issues.
Running the numbers, yeah. And then other savings, your partner's retirement plans. That's the other thing I was going to mention with an IRA or like a Roth IRA. There might be a single income couple and the spouse isn't working, and you could actually make Roth IRA, there can be an income limit, but for some folks, they could be making a Roth IRA contribution, not only for the worker, but also for the married spouse. And so if you're over 50, you could do, $7,500 this year for each of you. So that's $15,000 you could put in a Roth IRA and grow that tax-free. Now, there are some income limits, and we don't have time to go over all that. But, again, I see that overlooked all the time, and it's just a missed opportunity. So an advisor can help point those things out.
We have, what I'd like to do, Kevin, we've got 10 minutes left.
Okay.
So what I'd like to do is finish up the slide presentation in about 5 minutes, and then come back on together and kind of close up the session with the three of us.
Sounds good. So Social Security, that's another important decision as you're going into retirement. Do I take it early? Do I take it at full retirement age, or do I delay and take it at 70, for example? And it's not an either or. Like if your full retirement age is 67, you don't have to decide like, oh, I'm going to wait till 70 and I can't take it out anywhere in between. That's not true. You can say, okay, I'm going to try to delay. And if I can make it to 70, that'll give me the highest benefit at age 70 to take it out at that point. But if something happens, or I'm just not comfortable and I'm 67, you can take it at any time in between, right? You're just not going to get as much of a benefit. But what I think is overlooked oftentimes with, I think I have it right here. Yeah, this bottom bullet right here is, especially with a married couple, the survivor benefit of Social Security between the two is whatever the highest amount is. So if in a traditional couple where maybe one spouse stayed at home most of their life and didn't have a very big Social Security benefit on their own right, or maybe none at all, but the other spouse was the big breadwinner and has a huge Social Security benefit, by them delaying until 70, that just makes that benefit even bigger. And if they pass away, that 100% benefit is going to go to that spouse. But if they had taken it earlier and had that reduced benefit and they pass away later, that surviving spouse is going to have to live on that lower amount for the rest of their life. So if at all possible, in a lot of cases for clients, we try to delay till 70 just to get that higher benefit. It's a huge return. Yeah, well, right here it shows you too, like over 30 years for an average 2,000 benefit, it's $1.1 million, if you do it right. The average lifespan, the median lifespan here in Orange County for a married couple is in your 90s. Yeah. And so we have some really advanced software that can run literally thousands of different scenarios on how to take out that Social Security benefit to find out what's optimal. Crunching those numbers. Yeah, again, crunching the numbers. Okay, moving on. And there is a cost of living allowance or increase every year, or I should say adjustment. Anyone who's listening is probably retired. Let's go to the next slide. Okay. So this is that taxation question that someone asked about, how is the Social Security taxed? So just real quick, generally for most married filing joint, if your income is going to be over 44,000, then up to 85% of that income from Social Security is going to be on your tax return as taxable. So that usually is what's going to affect most people, what I've found. And then for single, it's over 34,000. So most people, especially in Orange County, you're going to probably need more than 40,000 to live on in a given year, and going to have that income higher. So whatever's above that, then you're going to qualify. And you're lucky, or aren't you lucky? You're going to get to qualify for 80% of the Social Security benefit to be taxed. Okay, I only have one slide on estate planning. These are the main types.
By the way, we have an entire series on the estate planning. And I think one of the most important aspects of going to a financial advisor is to help you decide who to name as the successor trustee,
Yes.
and to encourage you to get it done.
Yeah, get those estate documents.
Yes.
Otherwise, the government's got a plan for you, and
Exactly.
you're probably not going to like it.
Exactly. Let's go to the
costly. Yeah. So key takeaways: financial planning can be very complex. We just blaze through a million strategies and ideas to think about. People seeking a financial planner often either don't have the time, they don't have the knowledge or desire to do it themselves, or some combination of those three. And that usually means a financial planner could be of good service to you. And I feel the best type of financial planner to seek out would be someone with a CFP designation, the Certified Financial Planning designation, a fee-only type of advisor that follows the fiduciary standard. They can be your trusted partner through life, and help you specialize. Some of these advisors help specialize in certain needs that you have, so we can customize a plan for you.
Great.
Right.
I love it. Thank you, Kevin. Just so everybody knows that his Ask First form is on our website, and give him a call or email him if you have any personal questions that you want to discuss. Why don't you stop sharing your screen, Kevin?
Okay. There we go.
And
so the question that just came in, it's more a wrap up for us, is how long will these recordings be available? Typically, the recordings come up about a week after, just to let you know how soon they're available, depending on how long it takes to process it. They generally stay up until we do the next series. So they will be up, if we're now doing the fall, they will be up until the spring, at which point then we'll get into the new ones as they go along. So to answer the question, at least 6 months, it may even be a year. If you go now, you can see the ones from last spring. They're still there and will be available through that time. So
there's an amazing amount of content on that website. Some great knowledge.
Well, thank you. We try. Yeah. Lots of good articles on each session. And everybody's outline is located there. We don't try to we encourage you to use a financial advisor if you're confused, or if you have a broker. We think a fee-only fiduciary financial advisor is in your best interest, and usually is less cost. The average brokerage firm charges approximately somewhere around 3% if you dig into all the fees and expenses. And so, however, a fee-only advisor charges 1%. And do you, Kevin, on a quarterly basis, show the clients exactly how much that you have charged for that quarter?
Yeah, absolutely. They get an email every time, and it shows exactly what was paid.
Yeah. It's really much more transparent than a broker. If you are one of those individuals that want to do it themselves, it's okay. You can do that, but follow some of the steps that we have outlined today. Use a discount brokerage firm such as Fidelity or Schwab. Make sure that you pick out a mutual fund that is very low cost.
It should say an expense ratio if you look up the stats on a particular investment.
And all of the fee-only advisors will give you a free review of your portfolio. All the ones that we have presented here for the past 5 weeks and in previous years, I'd love to love to take a look at your portfolio and give you their 2 cents worth as to how it's designed. And it, just remember that a fee-only advisor is just not about the investment portion. If I can emphasize that more and more, the investments is the apple rolling off the cart. You know, we got to do a little bit of net worth. We got to understand your risk. We have to understand your diversification, your asset allocation. What are your goals?
Is that proactive planning approach? Yeah. Proactive planning. The broker advisors, they're gonna just be reactive, if at all. You know, they may help you with the investments, but anything else, typically, they're only gonna react if you call them and say, "Hey, what do you think about this?" And then you're not sure what kind of advice you're really going to get from them.
I want to give a shout out to Chapman University. They've been one of our longest sponsors of this program. They truly believe in education is top notch. And David Moore and Lindsay are just wonderful. And I want to like to thank them. They couldn't be here today because of a technical screw up on our part.
Yeah, a mistyped email address.
Yeah.
That's
yeah.
Sorry, Lindsay.
And Don, thank you for putting those workbooks together. They're on our website, and the charitable planning one, the financial planning one, and we have one on estate planning. And if anyone needs assistance as far as running the numbers for any kind of philanthropic plan, Don is our philanthropic advisor. He's a CPA. He is a engineer, CPA, anal type of individual.
My kind of guy. Nice.
Yeah. And we'll run the numbers for you at no charge. And as Don likes to say, he's a total agnostic as far as charities are concerned. And but you need to understand the numbers and see how they work out. Yeah. So I want to thank you, Don. I want to thank you, Kevin. Is there any questions on from any?
We've been doing good along the way. And Pete, I want to thank you for having started this last century.
Yes,
sorry, I had to do it. And keeping it going, because it's a wonderful program. So this has been It's Your Money. This is planning. Financial Planning 2 is the session we're doing, and it's the last one of the series. So have a wonderful time, have happy holidays and all the other things, and we'll see you some other time. Thank you very much.
Thank you.
Get Kevin. Get Don. Bye-bye.